Today we're going to talk about the SEP IRA and the Roth IRA because as we add multiple retirement plans together, things tend to get a little bit more complicated. So I'm going to share with you what I would want to know about these plans if I was considering using them or if I already had them. So I'm going to show you how to save the most and pay the least amount in taxes. And we're going to start with talking about who should consider these two plans. Then we'll talk about the contribution limits, the income limits. I'm going to give you some examples on making contributions to these plans so you can figure out how much you can really save into these plans. And then I'm going to show you some resources that I use all the time that will help you answer those questions that will inevitably come up along the way. And then finally, we're going to talk about some issues that might come up and possible solutions. Now let's go ahead and start at the top with who should consider the SEP IRA and the Roth IRA. Now, starting with the SEP IRA, it is a small business retirement plan. So if you're an owner of a small business or an independent contractor with or without employees, then you can use a SEP IRA. Now, it is only employer funded. So it's all pre-tax dollars that would go into it. So basically, if you want a retirement plan that you can reduce your taxes with, the SEP IRA is a great plan. On the other side is the Roth IRA, which goes in after tax. Now, the contributions to a Roth IRA have to be earned income. And this is income coming from either a W-2, a small business, or your independent contractor work. It can't be income like your investment income or rental income, which is considered passive income. So that is the way that you can contribute into a Roth IRA. And if that meets the criteria, then you should consider one or both of these plans. Now, let me show you the contribution and the income limits, and I'll go ahead and pull them up on the screen. So here are all the plans that I pretty much talk about on this channel, but you can see the SEP IRA here in green. And for 2021, the maximum amount is $58,000. For 2022, it's $61,000. And then that goes up to $66,000 for 2023. And the maximum amount of compensation that you can include in the calculation for 2021 is $290,000. For 2022, that's $305,000. And that goes up to $330,000 for 2023. And if you don't know what that means, don't worry. I'll show you what it means when we go through the actual example of making a contribution to the SEP IRA. Now, if we drop down to the Roth IRA, the maximum amount is $6,000 for 2021 and 2022. And then that goes up to $6,500 for 2023. Now, the filing status will determine what your income limit is. So for single and head of household, for 2021, it's $125,000 to $140,000. And what this means is that if you're filing as single and your modified adjusted gross income is under $125,000, you can make the max contribution of $6,000, but it begins to phase out as you move through the phase out to $140,000. So at $140,000 or more, you can't make a direct contribution to your Roth IRA, but you could look at a backdoor Roth, which I will also show you in just a minute. For 2022, those numbers go up to $129,000 to $144,000. And then for 2023, it goes up to $138,000 to $153,000. Now, for married filing jointly, those numbers are significantly higher. And just to point out, this contribution limits, these income limits, are based on your filing status. So it doesn't matter what your income is, it matters what your filing status's income is. So if you're married filing jointly, you have to add your income and your spouse's income. It's also known as a modified adjusted gross income, which I will show you that calculation too. So for 2021, it's $198,000 to $208,000. For 2022, it's $204,000 to $214,000. And then for 2023, it's $218,000 to $228,000. And just to point out on the SEP IRA really quickly, there is no catch-up contribution. So you see there it's on its own line item for the other retirement plans. And the reason the catch-up contribution isn't included is because this is only employer funded and the catch-up contribution is only employee funded. So since this plan is only employer funded, there's no catch-up contribution. So if you're 50 or older, no catch-up contribution for the SEP IRA. So let me go ahead and pull up my whiteboard here to walk you through how to make these actual contributions. Now, there are two ways to do the SEP contributions, and that depends on how your business is set up. So if you're a partnership or a Schedule C filer, then it is going to be your plan compensation, which is based on your net profit minus 1/2 of your self-employment. So if that number, let's say that number for your SEP is $100,000. The most that we can put into this plan is going to be a reduced rate, that's what it's considered, of 20%. So this is the most that you can put in. So 20% times 100,000 would be $20,000. Now, if you remember me showing you the numbers over here, and I'll pull them up one more time, for 2022, that plan compensation limit was $305,000. So what this means is if that, let's say you earned $1 million, the most that you can use the calculation for would be $305,000. And if we multiply that by our 20%, that's going to be $61,000, which happens to be the most that you can put into the SEP IRA. So if you want to max the SEP IRA, that is where your plan compensation needs to be. Again, net profit minus 1/2 of your self-employment. Now, if you're an S corporation, it works a little bit differently, kind of a little simpler. It's only based on your W-2 compensation that you pay to yourself, not on distributions, and the maximum rate is going to be 25%. And you might ask yourself, why, if I'm an S corporation, is it 25%? And why is it 20% if I am a Schedule C filer? The reason is because as a Schedule C filer, this number is based off of your net profit. Well, the amount that you're contributing to your plan is a business deduction. So they had to figure out a formula to give you a reduced rate because it's like, what came first, the chicken or the egg? In this case, what came first, your deductions of your net profit or your contributions. So that's why it's a reduced rate of 20%. And there's another way to figure out how much you can contribute if you want to do a lesser amount. It's still based on the 25%, but that's how it's done. With the Roth IRA, it's just making the contribution. However, if you're over these income limits, again, we're looking at these income limits right here, depending on your filing status. Let's say that we're over those income limits, then in order to make a contribution into your Roth, you can do it as a backdoor Roth by making that $6,000 contribution or $6,500 if it's for 2023, a non-deductible contribution into your traditional IRA, and then going ahead and converting that to the Roth. But I want to point out, if you're only watching the video to get to this point, you're going to miss out on some of the issues that you're going to run into with this math, which we're going to talk about in a minute. But before we do that, I want to go through some of those resources that I use to really answer those questions that will inevitably come up. So the first one is IRS Publication 560. And any of the publications that we're about to go through, you can just do a quick Google search and pull them right up. And this one has the information for the SEP IRA. And if we go down to the SEP, it's going to have all the information and help you answer most of the questions that you're going to have. And you can find things like how much can you contribute, some of the math that we just went through, employee eligibility. And then at the end of this packet, it has a little bit of a worksheet to help you figure out your contribution amount and also the contribution rate. So let me go ahead and zoom in here. And you can see that that rate I was talking about before, while it is 25%, technically it's 25%, but if you're a Schedule C filer partnership, it's going to be a reduced amount of 20%. And again, that's because it's employer funded, which is also a deduction, which reduces your net profit. So therefore, they come out with this rate worksheet to help you figure out a contribution rate. So this is the math if you want to do do it yourself. Or if you just want to use the cheat sheet, then you can use it right here. Honestly, most people just use 20%, and that's what I would recommend to contribute as much as possible into one of these plans. And it also walks you through the math for all of the retirement plans if you're self-employed to figure out how much you can use. This would also be used if you have a solo 401k. Now, the next publication is 590A, IRS Publication 590A, and this is going to be for the Roth. So if we go down to the Roth IRA, we can see all the same information that we just talked about, how much you contribute, who's eligible, and then we can see right here, this is your modified adjusted gross income. So if you're wondering what that is, the calculation is right here. And this is the same information that we would want to use for the phase outs. So if we saw the phase outs over here, and pull this back up, you can see the Roth IRA contribution limits and then the phase outs. Those phase outs are your modified adjusted gross income. What is that? You can do the math in the publication right over here. So that's your modified adjusted gross income. And the last publication is 590B, which has to deal with distributions from your retirement plan. So you can see how to take out money from your Roth IRA if you're under the age 59 and a half, whether it's for a first-time home purchase or whether or not you need to use it for educational purposes or for any variety of reasons. Or if you just want to take the money out of the Roth IRA, all the rules are right there. And the last one is the rollover chart. So this shows you all the retirement plans and where you can roll one to the other and how it works. So for example, if we have the SEP IRA and we roll it to the Roth IRA, we can do that, but it's going to be taxable. Why? Because the SEP IRA is all pre-tax funded and the Roth IRA is all after tax. So when we do a conversion from one to the other, that's what this would be considered. When you roll money from the SEP IRA to the Roth IRA, that is a conversion, and that would be a taxable event. So now let's talk about some of these issues that you might run into. And I say issues, doesn't mean it's right or it's wrong. It's just an issue that you need to be aware of so you don't get any tax surprises. So the first one is going to be making this backdoor Roth contribution that we just talked about. And when we do this, you have to be aware of the pro rata rule. So the pro rata rule says that we need to take an equal ratio of our after-tax dollars and our pre-tax dollars. So let's say that in our SEP IRA, we had $94,000. I'll just write that up there. $94,000 in our SEP, and then we have $6,000 as an after-tax or non-deductible contribution. Then we need to take an equal ratio. So what that means is that for each dollar that we convert into the Roth, 94% would be taxable. Now, if the ratio was different, it would be based on whatever that ratio is, and it ropes in all of your IRAs. So if you have a SEP or a simple or a traditional IRA with pre-tax dollars, then all of that would be combined. You cannot separate based on an individual account. You combine all the accounts that you have that are in your name, not your spouse's name, just your name. And in doing so, that is the pro rata rule. How can you get around it? Well, you can use a different retirement plan. If this doesn't work for you, you can use a solo 401k or a regular 401k because those plans are not included in the pro rata rule. This is only for the IRAs. So that is one issue and a possible solution that may or may not work for you in order to avoid the pro rata rule. Now, there is nothing wrong if you look at this and say, you know what, I want to do this, I want to get it into the Roth, then that is fine. I just wanted to point it out because if you did all of this thinking you're taking these after-tax dollars only and thinking that you can cherry pick these dollars, you would be incorrect and you'd probably get a tax surprise because you didn't report it. So again, in the example that we earned $100,000, that means we would start to add additional income to our tax return, which means you'd pay more in taxes. Now, again, that might not be a problem. Just as long as you know it, that's all you want to make sure that you're aware of. So that is the first issue. The second one is going to be how much you can contribute into your retirement plan. So we did the math where we had a plan compensation of $100,000, and then we multiplied that by 20%. That's the most that you can fund in a SEP IRA. However, if you had another retirement plan, say a solo 401k, then we can actually do all of that same math plus the employee contribution. So you can do an additional $20,000 plus $20,500 for 2021, bringing that total to $40,500. In addition to that, we could take these employee contributions and put them into the Roth side of our solo 401k, where the SEP IRA does not have a Roth side to it. So it really depends on how much you can save and where you want to save it, whether it's pre-tax to reduce your taxable income or if it's after tax to save you in taxes in retirement. So there's a lot of different ways to take a look at this. Now, the third one is looking at a last minute Roth contribution. So there's a bit of a timing issue here that could work in your favor or not. You just need to be aware of this stuff. So how does this work? Most people wait until the last second to do just about anything, including me. But if you wait until right before you're filing your taxes and you make the contribution to your SEP, thinking that you can then convert it to the Roth, you could, but you need to be aware that you can make a contribution up until your tax filing deadline, including extensions. However, at the time that you do the conversion is based on when you do the conversion, and you cannot do it retroactively. So for example, let's say that right before the April filing deadline that you made a contribution to your SEP IRA to reduce your taxable income, but then immediately did a conversion, that converted amount would be tacked on to the following year's tax return. Now, again, that might be what you want, to take money from one year, if it's a high income year, and put it on another just to get the money in the Roth IRA. That's perfectly fine. However, if you didn't intend to do that, thinking that the transaction was all retroactive for the previous taxable year, you'd be wrong. So don't fall into the trap of a tax surprise. Just know how it's done. And the last one we want to take a look at is looking at employees. So the employees will get funded at the same rate. Now, remember we talked about the rate over here, and I'll bring it up on the screen again. The rate for the contributions for you, if you're a Schedule C filer, is 20%, but it's a reduced rate. Well, if you're a W-2 employee of an S corporation, or you have a W-2 employee, they're actually at 25%. So that means if you're contributing to your plan, you have to do the same rate for your employees. Again, not a bad thing. You just need to be aware of it if this is the right plan for you. You might want to contribute that amount to your employee. However, if you don't, maybe another plan would be better suited, like a regular 401k or even a simple IRA where the matching contributions are significantly less, or the amount that the employer has to fund the plan is significantly less. And those plans also allow the employee to contribute, kind of incentivizing them that if they contribute, then you'll give them a match, where the SEP IRA is 100% employer funded. So there's a lot of moving parts here about the SEP IRA and the Roth IRA, and a lot of different strategies that you can use. So what might work for 1 year or one plan or one person, one corporation, might not work for the other. So you just have to kind of go through all those rules to really get a good idea if these plans work for you. And all of the issues could be used to your advantage with the SEP IRA and the Roth IRA to help you reduce your taxes today and tomorrow. Now, if you have any questions on the SEP IRA or the Roth IRA, let me know in the comments down below. And if you've enjoyed this video, be sure to subscribe, and we'll see you on the next one.